Some clients have asked me how to send money to their kids overseas without losing a lot of it to taxes. Recently, I had a client who wanted to send some inheritance funds to their kids in France. In this case, France has gifting taxes and inheritance taxes. So the question was, what is the best way of approaching this strategically from a tax point of view? My name is Sally Wright, your certified tax accountant. What happens if I transfer funds directly to my kids' overseas bank account? Could there be a huge tax bill that I have to pay in Australia? And also, my kids would have to pay overseas. In this video, I will share with you how to pay the least amount of tax while transferring money to your kids overseas. Here's the story. Bob and Sue live in Australia, and their daughter Sarah lives in France. Bob and Sue generously want to pass some of their savings onto Sarah. France has inheritance tax laws. In France, there is a limit on gifts that you can receive from family members. Sarah is our client, and she asked what would be the best strategy for her. If Bob and Sue blindly did a bank transfer of $400,000 to Sarah in France, Sarah would only get $200,000 in her bank account after paying all the required taxes. And this is not a good result. Our advice was Sarah could keep all assets gifted to her in a discretionary trust in Australia. A resident trust can be set up in Australia with the resident company as a trustee with non-resident beneficiaries. Sarah can be the sole director, and Sarah and Sarah's children will be the primary beneficiaries. And the trust would be discretionary as opposed to fixed trust, whereby the beneficiaries do not have a fixed entitlement, but receive their entitlement to the income and the capital of the trust at discretion of the trustee, which in this case would be Sarah. The resident trustee will pay Australian tax at the non-resident tax rates for Sarah and Sarah's children. A higher tax rate applies for minors, and the trust will be discretionary to avoid the higher tax on minors. I noted that the trust net income must be distributed for tax purposes, as cumulated net income is taxed at 45%. So, if Bob and Sue follow the advice we gave them when they put the $400,000 in the trust for Sarah in Australia, Sarah would ultimately get benefit of $400,000 without paying inheritance tax in France upfront. This is a fantastic result. How to send money to your family members overseas without losing most of it to taxes? It's beneficial for asset protection, tax strategy, and better control in the trust. Please note that what we designed for Sarah might not fit your situation. Please give me a call or comment below with your questions, as I'm happy to help. If you enjoyed this information and liked our video, please check out our YouTube channel to subscribe for more financial insights. Please click on the bell icon to get notified about our next video. I'm Sally Wright, your certified tax accountant. I really appreciate that you watched my video and hope it helped. Bye guys, and take care.